David Stein had an innovative marketing hack for growing his investing podcast called Money for the Rest of Us. He put the names of other popular finance podcasts in his metadata, and Apple's unsophisticated search algorithm would surface his show whenever people were searching for his competitors. By the time Apple eventually eliminated that functionality, Money for the Rest of Us had built up a loyal audience that's since downloaded the show over 20 million times. His audience is so loyal, in fact, that it sustains a high-priced membership community that charges $450 a year and generates well into the six figures in revenue. In a recent interview, David walked me through how he developed his investing expertise, what he offers to paying members, and why he launched his own premium investing app. Hello, I'm Simon Owens, and this is The Business of Content, the show about how publishers create, distribute, and monetize their digital content. If you want to listen to an audio version of this show, subscribe to The Business of Content wherever you get your podcasts. By the way, have you ever wondered how I monetize this show? It's entirely reliant on subscriptions to my Substack newsletter. When you subscribe, you're able to book a half-hour introductory phone call with me. You also receive subscriber-only interviews with some of the world's most successful media entrepreneurs. Support the work I do here by subscribing at simonowens.substack.com. That's simonowens.substack.com. Or just Google the words Simon Owens and newsletter. And finally, if you're on the lookout for interviews with the world's most successful media entrepreneurs about how they built their businesses, then this is the show for you. So take a few moments to hit the subscribe button down below. Okay, let's jump into the interview. Hey, David, thanks for joining us.
That's great to be here. Thank you.
So we're here to talk about this awesome podcast and online community that you've built over the years. But first, I just want to kind of like dive into the origin story. So it's this finance community, this finance podcast. You actually originally came from the world of private equity finance. How did you kind of break into the world, and what was kind of your initial career like?
Yeah, so I have an MBA in finance. And so, after doing corporate finance for a couple of years, I joined an institutional asset management firm, an investment consultant, working mostly with university endowments, foundations. I was there 17 years. I became a managing partner. I was their chief investment strategist and chief portfolio strategist. So I spent time both managing assets, working with clients such as the Texas A&M University System, Sierra Club Foundation, and then was in my mid-40s and decided I had met my number financially as a partner and was just ready to try something new. So I left that in 2012 and launched Money for the Rest of Us. A couple years later, there was some iterations between leaving and starting the podcast and community, but that started in 2014. So it's been 10 years.
So working in private equity, you were kind of, obviously working for investors with a lot of money, or like you said, large endowments and stuff like that. And we'll get into this in a minute, but it seems like what you're now focused on is retail investors or personal finance, things like that, like individuals who maybe are in the middle class or whatever, who want to manage their money better. Were you always kind of interested in that side, or did you eventually grow tired of working with like the big like moneyed investors and wanted to go over to that side? Or what was kind of like your philosophy on that, like as you were in your career in private equity?
Well, two things. One, when you work with let's say university endowment, there's typically an investment committee. And so you're working with individuals, you're providing education and teaching them. And my podcast is that most of them, we rarely do interviews. So it's mostly a solo show, just teaching about investing, the economy and money for 25 minutes, which is not that different than what I would do with an investment committee. But also as part of the portfolios we managed, we also managed assets for financial advisors. And so I spent time not working with individual clients, but with advisors. But I'd speak at conferences, et cetera. The individual investors in many ways they just don't get the same tools as institutions do. And there was a desire to bring that institutional approach, asset class focused, and just to individuals to help them, many which need help because they're interested, and a lot of that information just wasn't available.
So you're kind of like your edge or kind of your pitch for yourself is you're taking all these skills that you were giving to, rich investors, and you're kind of giving it to the masses, basically unlocking these features and stuff
Well,
like
right, yeah, for the rest of us, essentially, and that's the idea.
money for investing for the rest of us. So you left in 2012. Was it like you kind of like, was it quasi retirement? Were you kind of burnt out? Like, what was kind of your motivation for leaving
Yeah,
private equity?
I mean, we told clients I was retiring. I mean, I was not planning on working full time. Now I still, I guess I don't really work full time, but the idea was to, having spent 17 years saying we think this, we think that, I wanted to say this is what I think. And so that was part of it. And just for a change, I just couldn't, I was at the peak of my career. I mean, there was no ladder love, there was not another rung on the ladder. And I was just, in some ways I was burnt out. I was tired of playing the relative performance game. The institutions, or all investors, can be very short-term focused, and they're very relative return focused. Like, is our portfolio, how is it doing relative to the benchmark, such as the S&P 500? How are we doing relative to peers? Which, not that that's bad, but it can be a little short-term focused. Your typical institutional investor has about a patience level of 3 years. And so if there's an aspect of the portfolio that's not performing the way that they would expect, then after about 3 years, they get tired and they're ready to switch. And that can lead to unnecessary churn in a portfolio. And I just kind of wanted to do my own thing.
hmm And did you have any inkling of what you wanted to do? Because I know there was like maybe a 2-year gap between when you left that firm and when you launched the podcast. Like, were you thinking about
Yeah,
what you wanted to do next?
I started under my own name, a website, and several others right after I left in 2012. So which was a little weird because I quit, and then suddenly I was doing a lot of the same thing. It's just I wasn't getting paid, and so I went for, I tried a number of different things just to try to find, and for a while I just quit altogether. I don't want to talk about investing. And then the local newspaper in Idaho wanted me to start writing a column for them. And I thought, well, I could write a column once a week. And that kind of got me back in. And a few months later, I had been a guest on a podcast in 2014. There weren't that many finance podcasts. So I launched the podcast and found that I enjoyed that. And I kind of enjoyed teaching. So it was good to step away for a couple of years, try some different things, but then come back and do it in a way that fit my temperament.
So you, as you said, you went on as a guest for a podcast. What did you like about that medium? Like, what kind of attracted to you to
Well,
that?
one thing I liked was, one, it's just enjoyable to talk finance again and just be able to teach. But I also, about then you started to see more unlimited data plans on phones. So people were accessing audio on phones in a way that they hadn't before. Prior to that, podcasting, was more challenging as people would download. And so it seemed like an opportune moment. I was also doing YouTube at the time, playing around with that, and I wanted to try it out. So, and then it was a good time to get into podcasting, and so it kind of went from there.
So you launched this podcast. What's the name of it?
Money for the Rest of Us is the name of the podcast.
Money for the rest
Right.
of us. So what was the format?
The format was, 25 minutes. I'll teach on some aspect of money, the economy, finance, investing, and just share stories. So it's narrative driven, like what's happening in the markets. Try to use examples of what's going on. It just to try to make what's going on digestible to individuals so they understand it. Try to take complex topics, simplify them so people can grasp what's going on.
So it's like almost like a finance Wikipedia on like individual topics, like just kind of going deep on them.
Yeah, yeah. Just, for example, a recent episode is a retirement savings crisis. This past week, 10 things I've learned in the past decade investing. Variety, just whatever I find of interest that week, then I'll research it, for 3 or 4 hours, and 5, 6 sometimes, and then on a Monday, early Tuesday, and then I'll record the episode and we'll get it out that week.
And like, are you writing a script? Are you creating an outline? Or are you just doing the research on a topic and then just kind of riffing for 20 minutes?
I have an outline. I don't write a script, so there's definitely an outline. And I used to. I mean, the early days, that was it. I would sit there. I'd have my outline. I'd speak and put the intro music in and upload it. Now we do a little more editing, a lot more editing actually. Mostly,
You
it's hard.
edit
I
out
mean,
the
it's
ums and the ahs and stuff like that.
no, not so much that. It's just I just I pause, right? I mean, you can't typically talk for 25 minutes without there being some gaps to figure out what the next word is. And listeners, I think as a rule, people want faster audio. And so we basically take out some of the gaps. And I mean, it still sounds human, and it is, but it that helps.
So like a lot of podcasts, including this one you're on right now, like it's a dynamic between at least one, two people, if not more, because it's a little bit easier to have a conversation. Whereas like some people, including me, would have a hard time just sitting in front of a mic and just talking. Like some people have that talent, and you know I don't in particular. Do you feel like you have that? Like, why did you decide? Why did you decide to just have you speak into a mic versus having someone else on? Was it just because it was just easier that way, or do you find like you have like a natural ability to just like talk into a mic for 20 minutes straight and sound intelligent?
Well, I had spoke. I mean, I was already used to speaking. So, like I said, with speaking at conferences, speaking with clients. So I was used to teaching for 20, 25 minutes. And I mean, there would be questions, but so I could carry an audience. And so that actually was less intimidating for me in 2014 than the idea of trying to figure out the tech to do an interview and have to book the interview, et cetera. So it was just easier for me to just, and partly I knew that I wanted to monetize through courses or premium content. And as a result, I wanted people to relate to me. I mean, when you're just doing interviews, you're basically, I mean, if you're sharing, you're letting that person be the spotlight, which is fine. But I wanted to share what I was thinking, and so that's why I chose that format. And it is easier for me. We'll do a couple interviews a year, not very many, and partly, well, because we're differentiated. There aren't that many solo podcasts, and so, but occasionally there'll be a book I read or just something that I just want to add. I want to interview people, and despite that, I mean, we'll get dozens of requests for interviews a week, even though we basically hardly ever do interviews.
And how quickly did it find an audience, and where did it find an audience?
It took off pretty well, and partly there weren't that many, and partly Apple's SEO was easy to hack. Back then, you could in the author field, you could put. Oh, no, I did put like this is like Planet Money and like all this some of the NPR like podcast, and because the way that their SEO worked was it was based on the name. So if I had Planet Money in my podcast, I mean in my author field, and then it would rank based on that number of downloads. And since there weren't that many for years, if somebody searched Planet Money on the Apple app or any app that was using the Apple catalog, my podcast would show up next to it.
Yeah, so like to just like in the metadata or like the author field or something like that, you would put Planet Money in it, so people would search for Planet Money, which was a very popular NPR podcast, and Planet Money would come up first, but then maybe yours would come up second.
Oh, right, yeah, and
Yeah, and then also and then you were also like doing these kind of evergreen personal finance explainers and stuff like that, so people searching for those terms, because you didn't have a lot of competition, that was coming up pretty high as well.
well, at the time, yes and no. Apple never indexed based on the title of the episode or the topic. Yeah, it was basically the name of your podcast and your name. And any other names that you put. I mean, I put like David Stein, this podcast, plenty is like these three shows, but it didn't. Yeah, they just, and it was like that. I think until at least 4 years.
So you really just
2017. I mean, it wasn't anything. It wasn't wrong. I mean, they never said anything. No, eventually, apparently, they said you shouldn't do that. And then I got kicked out of the Apple Store for a week because my podcast got taken down. And all right, I fixed it, and that was fine. But no, podcast as a rule, is that and word of mouth, but they're not. They don't go viral typically, and they're not easily searchable even today. And so it's very, very difficult to launch a podcast and for it to be successful to grow, which is why your median podcast episode gets 200 downloads because it's hard to be found.
interesting. So you really kind of like hacked a flaw in the Apple system and also, benefited from there just not being that many
Right,
podcasts.
right.
But there was this explosion caused by Serial's popularity, but all these people now were newfound podcast listeners looking for more stuff to listen to, and
Right.
there really was a vacuum at that point before all the media companies and VCs started investing in podcasts. So you start building up an audience very quickly, as you said. Like you're from the very beginning. You weren't thinking about like mass scale. You were thinking like, how could I funnel people to like high priced products, right? So like you said that you sold a course very early on. I think it was even that same year, right?
Yeah, it was that same year, and it didn't sell well. And because I was using one of the course platforms, I forget which one it was. Thinking,
I think you told me it was Udemy,
oh
maybe.
yeah, Udemy,
Yeah.
and but it's like anything. Like you get on a platform, some are incredibly successful because the algorithm chose them, right? And I thought, well, there aren't that many. Well, the algorithm didn't choose me back then, and so I thought, all right, well, I'll just market to my own audience. So I launched the podcast in May. In December, I launched the premium community. So, and that's been our main source of revenue for 10
So
years now.
you launched you launched the course before you did
Yeah. So I
the
launched the
community.
course in, I think that fall. It was something like 7 steps to invest or something like that. I mean, it's fine, but it just like, well, whereas the community took off from the get go. And so that, and that's basically it's a subscription service is what it ends up being.
So I think, if correct me if I'm wrong, you originally charged like what, $200 a year for that community. It's since been, the price has been raised since then, but that was what it
Yeah,
started out
yeah.
as.
So it was, I think we did 20 a month or 200 a year,
Hmm.
and
And so what did you offer? Like, what was kind of your pitch for joining a community?
we offer way too much. Is what we offer. So they got an additional premium Q&A podcast every week. I was doing an audio lesson. They had a forum. I did a monthly investment conditions and strategy report, which is basically looking at the markets and what's going on and economy, and we still do that. And I think no, we didn't offer any model portfolios then. So this is just mostly content on investing. Most of it audio.
Yeah, and what platform were you using to kind of what
We
to like?
used, oh gosh, I forget the name of it. It was a platform that basically did a custom version of WordPress, and they were using MemberPress in the background. It was
Oh,
owned
okay.
by
So did you
it was
eventually?
started by Copyblogger. They've since sold it, and what was that called? But anyway, it was a platform. So it was sort of, they put it all together, they ran it, and so I hosted it on a separate website. We've since transitioned to hosting it, our own WordPress install on MemberPress.
Hmm.
So,
And like, how did you drive people to the community? Was it just literally like click on the link in the notes in the show
well, I
notes,
mean,
or?
from the get go, we did a newsletter. So our main call to action in the podcast was join our Insider's Guide email newsletter, and so we would pitch it through that, and I talk about it. I mean, obviously, if I'm a solo show, I can talk about plus member ask this, or I would use it, and so I would just organically would talk about it, and so about 3% or so of the audience joined, which wasn't, the audience was big enough that we had start out with a few hundred members join, so it was enough.
Yeah, and so it eventually you raised the price to like what, $400 a year? That's
So
what it
we're
is
at
now.
450 a year, although it will, based on activity, as people interact with their newsletter, get on the website, we'll send a discounted offer to them. So our average member is paying around 300 now. Some are paying higher, some are been there a long time. We have hundreds of lifetime members, so we tried that as an experiment, and that worked. And yeah, so
And I
and
think
raising the price helped. I mean, if you're running a membership community, we kept the price the same for existing members, and then raised it for new members, and that kept old members from quitting because
I
they
do that
could
too
lock in
whenever I
their
raise
earlier
prices.
price, right?
Yeah. Yeah. And then when you're about to raise a price, you can start, teasing that and saying, hey, if you want to get locked in at this lower price, sign up
Oh
for
yeah,
now. And that
yeah.
causes a rush of
And we
signups.
would. I mean, when we raised the price, I think in 2020, meaningfully, we went from 300 to 450, and yeah, I think we had several hundred members join just then. I mean, there's a lot of people. Probably fence sitters isn't the word, but just indecisive, and so sometimes they just kind of need a push, and locking in a lower price can help with that.
Mhm. So, and I think the last time we talked, you had somewhere north of like 1,000 subscribing
Hmm.
members.
And we still do,
So it's,
right? Yeah.
yeah, yeah. And so that's like if they're on doing an average, just doing back the envelope, just the subscription business alone is well into the six figures, throwing off $300,000 a year. But you've also started to expand into some other things. Eventually, your podcast got like big enough to where you could actually start selling advertising on that specifically,
Yeah,
right?
yeah. So I think we started doing ads in 2016. So we were with Midroll, and we've done ads since. So we'll run 2 ads an episode. So Audio Boom's our sales agent now, and yeah, so we've run that advertising ever since. So, and which has generally
And are they
been
doing? Mhm.
about
Sorry.
25% of our revenue or so.
Yeah, and it's like, is it programmatic or are you
No,
doing host read
they're
ads
host read
or?
ads. Well, we host with Art19, so if we have an open spot, or in the past we would run programmatic ads. Now we run a programmatic pre-roll. So in older episodes, so episodes older than 3 months or so, we'll run a programmatic pre-roll. But we've cut back given the chaos in the ad space, which I suspect we'll talk about. And so we're basically running our existing sponsors and just keeping them in at this point. We used to keep them in for 3 months, but given it's harder to get the impressions, or because we pre-sold ads a year ago, we sold ads last October for 2024. And with Apple's iOS update, most podcasts are finding that the promised impressions aren't there, given same number of listeners in many cases, but in terms of downloads, it's not the way it was. And so we're keeping the sponsors in longer to meet our contractual commitments.
And are most of the sponsors like investing services and stuff that want to reach like retail investors?
No, most aren't actually. This year our main sponsor is LinkedIn, Monarch Money, which is kind of a budget service, NetSuite, Shopify. So we don't.
Mm-hmm. So business adjacent type
Yeah. It's
sponsors.
people they're sponsors that want to get in front of a very high net worth educated audience.
Mm-hmm. And so you mentioned the iOS update. So that's when iOS updated its podcast apps and the way that it automates downloads. So it used to be if someone kind of fell off listening to a podcast, it would stop downloading new episodes. But then if they started listening again, then it would go and download all the back catalog of the episodes or a bunch of the episodes that they hadn't listened to. They stopped doing that, and suddenly there was a huge crash, at least in the number of downloads across the entire podcast industry. As you kind of alluded to, a lot of these podcasts that had a ton of industry saw a ton of inventory suddenly saw their inventory like cut in half in some cases, especially for like daily podcasts and stuff like that. So, like, how did that affect you?
It's the same as everybody else. I mean, the podcasts were down 50%, mostly back catalog. But even the way that they do it, if somebody, I think if they haven't listened in 3 or 4 weeks, it stops downloading the episode. So, but surprising. So what's interesting is we just raised our rates. So, all right, the if we promise so many downloads at this absolute dollar amount, then well, it's not like there's less listeners and the ads are still effective. We're still converting, so we basically make the same amount of money. We just promise less downloads.
Yeah, and
And so
I'm guessing, or
raise the CPM. So the cost per thousand, we almost doubled it.
yeah, and I mean, technically, marketers and advertisers are kind of accounting for those like false download or
They
those
were, yeah,
false
they
listens,
were
but
right.
and so they were, they recognize that you still have the same size audience as before, so the technically your audience should be worth the exact same amount that it was worth before, even if the download numbers are lower.
Yeah, I mean, we for next year we've had to cut our rates some, but just because I mean, I think the audience is smaller because there are so many more podcasts out there, and I think short form video is encroaching in the podcast space. So I think there are your typical podcast is seeing fewer listeners, just not only because of the iOS update, but also because it's hard to find new listeners to replace old ones that prefer TikTok or Instagram Reels.
Yeah, so like even though there are way more podcast listeners than there are to more podcast listeners today than there were 10 years ago, there are also way more podcasts. And so you've definitely, have you felt that it's just harder to grow now
Oh
than
yeah,
it would have
no,
been
it's
back
been
then?
harder to grow
Yeah.
since for the last 4 years.
Yeah. And
We
as you
used to
alluded to,
see 50,000 new podcasts a year, 100,000. That's sort of 2018, 2019. Million new podcasts in 2020, another million in 2021, and now you still get hundreds and hundreds of thousands of new podcasts every year. And so it's a tougher medium than it's ever been.
yeah, and as you alluded to, podcasts are kind of morphing into having these video components where they're like, this episode now is going to air the full thing on YouTube, but then also podcasters are getting more savvy about then cutting up those clips and distributing them on YouTube Shorts and Instagram and TikTok and stuff like that. Have you tried to get into video at all, and what's kind of your strategy been if you have?
Well, we recording myself recording is boring video, so that doesn't work if you're a solo podcast. But we have you done YouTube in the past where I've just recorded a separate video and a video in a video. Even YouTube is a challenging medium because there's so many more personal finance video. I mean, I started uploading finance videos to YouTube in 2012. So I've toyed with it. I've never stuck with it the entire time to my fault. But even when we have, it's not easy to be found. And so, I mean, it's easier than a podcast because if you can search, the search mechanism is better. But no, so what we did instead is realize, all right, we're not going to be in the podcasting business long term. We got to do something else. And so we launched a different company, a software as a service company, basically a custom built membership community that is, so the premium membership community was always what we called plus membership was here's what I think, here's expected returns, here's our monthly report. But because the index providers controlled all the data, we couldn't really give them the tools, right? And so there was very much receiving, here's what we think. And we launched something called Asset Camp last year where we actually give people the tools. So here's all this information on 48 stock indexes and 28 bond indexes. So basically what I would have dreamed of to have as an institutional money manager. And as, even as an educator, we were paying, our research budget was $100,000 a year that we would pay for resources to share with Plus memberships, but we couldn't share a graph without getting permission from our vendors. And so we decided this is stupid. we're going to sign licensing agreements with Bloomberg and MSCI, and we'll just build the graphing capabilities ourselves and then share it to people that want that type of data for $200 a year. So that's our main avenue. And with anything, you have to, we'll grow it through the podcast, but we're much more active on LinkedIn. I'm done here. I'm going to record a video short. And then paid advertising. And that's
So
ultimately
let's
what we
talk
have
about
to
this.
do is you just can't wait for people to find you anymore like they could. And so we have to and do paid ads, and that's what we're working on.
So just to kind of translate everything you just said, let's dive into this. So like you're transferring our company from being like a content media slash membership community type company to like basically being like a bootstrapped fintech company. Is that
Yeah,
kind
no,
of
that
the
is,
kind of an overview of what you're
yeah,
doing?
no,
And so you built this thing called Asset Camp. Is it a mobile app? Is it a web app? Like what is the
it's
actual
a web app.
interface for it?
I mean, it's mobile optimized, but it's a web app, and it has many of the features of our Plus membership. I mean, there's people can do expected return modeling. I mean, we're answering three questions like what happened with the markets, where are we now, where are we going, and take action. And so it's the same steps that a university endowment would take that as individuals we should be taking. Most don't. And so it allows people to understand what is driving index funds and ETFs, to understand what's under the hood as opposed to just guessing.
And are you like licensing APIs that you're then plugging into it so the app is up like updating with new information
Yeah, no,
consistently? Like what is actually
it
going on there?
updates monthly. So we pull I'd like to, well, it's not an API. I wish it was, but it's basically, yeah, the data server, you bring down the raw data, and then our software creates the database, and then we have the front end. So and a lot of the tools were value added that it it's amazing as an individual investor. You cannot get if I want to know what is the historical valuation price to earnings ratio for emerging market stocks, as a whole, an ETF, you can't get it. It's just not available. And we tried for years to get it. To like even I signed up for Refinitiv. Well, they ought to have historical valuations for emerging market stocks and other indexes. No, Y Charts doesn't do it. I thought MSCI, we signed this agreement with MSCI. It's like, oh yeah, we'll give you a file you can download, but we don't have any graphs or charts. And I'm a picture person. I want to see a graph. Is the market expensive? Is it cheap? And so that's what we
And
built.
like so you're getting into kind of like an adjacent thing to like Bloomberg terminals, for instance. It's like I mean, would you kind of consider yourself to be in kind of that category of product?
Yeah, except they charge $30,000 a year and have way, way more data. And we're very focused on right now stock market, bond market, and $200. So it's more user friendly. Plus, we have what we found within the fintech space. A lot of things are built by engineers, but nobody shows you how to use it. So we do a monthly live webinar showing people here's what's going on. It's kind of like the IKEA model where you buy something IKEA, everything's sort of pre-made and you put it together. And we wanted that level of transparency. It's like, here's everything, but here's a monthly webinar. Here's what it means. And here's
Hmm.
what you can do with it.
And so it's you said it costs $200 a year. So this is something that you're running separately, completely from your membership community. Like that, this is a separate product that they subscribe to.
Yeah, it's separate. And partly because the membership community is built on member press, and it needed to be custom because it wasn't available. So we built it through Stripe. I mean, Stripe's handling the subscriptions, which is how MemberPress. Stripe handles the billing and all that stuff. So you basically build it with Stripe handling the customer service, which wasn't available 10 years ago when we launched the Plus membership, not to the level you could do it today.
Yeah.
So
So you have experience running a subscription thing, but a completely different kind of subscription. What are you learning about how hard, how difficult, how easy it is to do a kind of like a more SaaS product versus a membership community? Like, what are some of the differences, or what are you finding is like way different running this thing versus running your membership community?
well, what I like about it is the software. Like, these are the tools that I wish I had as a manager, that I would, if I could have done it 10 years ago, this would have been our Plus membership. Like, give people, and because they've asked for it all the time, how do we replicate this ourselves? How do we analyze it ourselves? And so it's way more powerful than what we currently offer. The challenge with anything is finding who's it for, like finding those people that want this type of data. And we know that they exist, but it's like anything. I mean, there are people that want to know what happened and do a performance attribution to understand, is the market cheap, is expensive, be able to rank. I mean, there's hundreds of fintech companies that do this for individual stocks, which is always way more sexy. Like, if I can find the next Nvidia or something like that. But most investors should be focused on assets, like which area of the stock market should have more in US versus non-US. And those tools aren't available for individuals. And so it's bizarre to me, but it's like anything, you just have to keep, we've had to refresh it. We just released the bond component last month. And so it's slow growth. It's a grind.
Do you find it easier to convert people to a SaaS subscription or a membership subscription?
It's about the same. Partly, I mean, the membership in some ways was easier because they listened to whatever, lots of audio of me beforehand, and so it's sort of like, all right, we know who David is. I want more content. I want to listen more. So this is different because we're bringing in people that aren't familiar with our work, and we're not selling me. We're selling a process. We're selling the data, or a way to manipulate, understand data, and so it's different.
Is the attraction kind of the same attraction to any kind of tech company? It's kind of the infinite scale type of thing. Like, do you want this to be your legacy? Is building the next Bloomberg for X type of thing?
Well, I just want to be successful in the sense that I know we have this my two sons are partners with me. So we have three kids. They've all worked for me, with me for the last decade. They all work with me now. The two older sons, adult sons, are partners. And so we want to grow this to where we can work half the time that we're working now. So it's not so much legacy. It's like, this is powerful tools to be helpful to people. It does scale infinitely. We did bootstrap it. I mean, we could have taken outside funding, but we don't want to, because we want to do it ourselves and grow it slowly over time, as we iterate and figure out what people want. And that's our approach.
Have you ever thought, like, man, this would be so much easier if I had a few $1 million in VC cash to like hire someone to just think about, paid acquisition or something like that?
No, having spent the last few months doing paid acquisition, most VC funded companies fail. And most, even when they go public, still haven't figured it out. They're growing, but they're losing money because they're paying more to bring people on than what their acquisition cost is, greater than their lifetime value. But they're still going. So I've never figured out a profitable business model, because, as it turned out, paid advertising is incredibly difficult. And you have to be in the market longer. You're always testing and figuring out, all right, this works, or because people, it just takes time. And so, no, if we had a lot more money I mean, the product's already there. So, I mean, we built it, right? and it's a VC could not have built it any better because it was based on 2 decades of experience in managing money and looking at all the products out there, many of which cost tens of thousands of dollars per year. And so at this point, if we brought in VC money, it would just be to run even more ads, and we'd still be trying to figure out, okay, why did this ad work? Why didn't this ad work? And so we'd rather it's easier to micro test on our own to figure it out.
And like, how much from your own kind of personal network audience is driving, membership in this app versus like just paid acquisition and just educating the broader
It's
marketplace?
about, it's probably 2/3 of our existing audience. Right.
So you think there's like a lot of scale ahead of it outside of your already existing audience, probably.
Oh yeah. I mean, there's 300,000 financial advisors out there, and you think of White Charts, which focuses on them. They have 6,000. Like it's yeah, because this is how you manage money. It's not like, and it's sort of kind of frustrating because it takes forever to grow things. But everyone has a 401k, and some want to, like, they're more interested in figuring out, well, I put it all in the US or non-US? What are these things? What's a reasonable return, or any of that stuff? Is the market expensive or cheap, or how does it even work? Like, this is, in fact, I did the episode I did recently on retirement savings crisis. There's a crisis because basically most people don't have a pension plan anymore. And they've been responsible since the early 80s for managing the retirement and taking on the risk. And it worked great for the first 10 years because the stock market was super cheap and the bond yields were super high. And so you had this huge tailwind in the 80s that made lots of millionaires in 401k. But since then, it's been much more difficult. And your average 55-year-old has $200,000. The median, the middle person that's 55 to 64 has $200,000 in their retirement portfolio. And if you spend 4% of that, which would be what an advisor would recommend, that's $8,000 a year to live on in retirement, plus Social Security in the US. Like, that's a savings crisis because people don't. I mean, and I used to do this at my old firm. I would do 401k education. And it was laughable because I had one shepherd or a chemical company client, third shift come, they're trying to stay awake, and they want me to talk to them about asset allocation and your 401k options, and they're trying to stay awake. Like, it's stupid what has happened. And I had pension fund clients, and you had a professional management, you had a committee, you had risk pooling, and now everybody's on their own without the tools to really figure out what's going on. So we've built a tool.
So when you look 2 to 3 years down the road, what do you want to be doing that you're not doing today? Or maybe for you, it's actually the opposite. What do you not want to be doing that you're doing today? Like, do you see yourself winding down the membership community to focus 100% on this, or like, what would you like to be doing?
No, I mean, we sold hundreds of lifetime membership. So I'll keep writing about investing. I would like to podcast less instead of doing a weekly show. In fact, next year we'll do fewer episodes. I'd like to write another book. So Margaret Hill published my book about 5 years ago. So I enjoy writing. We travel. So we will keep, and I've done this for 10 years. So I'm used to teaching, spending time learning and teaching. So, and I still like podcasting. I just don't want to be on a hamster wheel, we'd like to stop selling ads. So that would help because then I can podcast when I want. But no, I've done this long enough that I know that I'll keep writing about investing and teaching.
Is the goal that this app will be the vast majority of your revenue by that point?
Yeah. No, I mean, because this is scalable. Again, because it's not, people aren't having to wait around for us to tell them what to think. They get everything and they can see it. and do the analysis themselves. So it's much more scalable.
Okay, David, those were all the questions I have for you. Where can people find you online?
You can find us at moneyfortherestofus.com is our main website. Also, assetcamp.com is our SaaS product.
Awesome. Well, this was a lot of fun. Thanks for joining me.
Thank you.